In the last video, we covered the basics of mutual funds. As you guys know by now, there are types of mutual funds like equity funds, debt funds, hybrid funds, and commodity based funds. Now, within equity mutual funds, there are different types of subcategories. These are based on market capitalization, diversification, sector and themes, and solutions. In this video, we will be covering the equity mutual funds based on market capitalization. Hi, welcome to Aarthi Tax Info. So equity funds based on market capitalization. What is market capitalization? It is nothing but the value of a company. So number of shares of the company multiplied by the price per share. That is market capitalization. So based on this market capitalization, as you already saw, there are several categories of funds, but we will be mainly focusing on the three major kinds of funds. That is large cap funds, mid cap funds, and small cap funds. The other category is the index funds. I will be covering in a different video. So large cap funds. As per SEBI's categorization, large cap companies are the top 100 companies in India based on market capitalization. So these have market capitalization of more than rupees 20,000 crores. Examples would be Reliance, Tata, Infosys, HUL, etc. So based on SEBI's mandate, the large cap funds have to invest at least 80% of their assets into stocks of these kinds of large cap companies. They are robust companies who have been in the business for several years and have been known to generate regular dividend, which result in steady compounding of capital. NAVs of all mutual funds fluctuate based on the market. But if you are invested in a large cap fund, as these are big companies, huge companies, the fluctuation would be, and the volatility and fluctuation would be relatively less when compared to a mid cap fund or a small cap fund. If you are invested in a large cap fund, you have to stay invested for a period of at least 5 to 7 years for you to get a decent return. As per the latest data, the following are the top performing large cap funds. Baroda BNP Paribas Large Cap Fund gave a return of 20% per annum for a 5-year period. And Nippon India Large Cap Fund gave a return of 17.52% per annum for a 10-year period. Now, mid cap funds. Mid cap funds deals with mid-sized companies. That is, these are companies ranked from 101 to 250 based on their market capitalization. That is, market capitalizations more than 5,000 crores, but less than 20,000 crores. These are companies in the phase of growth. So they generally tend to give market beating returns. By market beating returns, what I mean is, suppose the Sensex or the stock market grew by 10% or 15% for a particular period. These funds would always give you, if they're performing well, they would always give you returns much more than that, maybe 20, 25, 30% also. So many of these mid cap companies go on to become tomorrow's large cap companies. But that is not all. That is not the case all the time. Some companies might go bankrupt also, because in the event of an economic downturn, these companies tend to get affected much more than that of a large cap company. They tend to weather this storm much better. These things should be kept in mind before going for an investment. And the general time for you to stay invested to earn this much of returns is 8 to 10 years. These are the top performing mid cap funds as per the latest data. Quant Mid Cap Fund gave an amazing 42.92% per annum return for a 5-year period, and Kotak Emerging Equity Fund gave a return of 23.82% per annum for a 10-year period. Now, finally, small cap funds. Small cap funds deal with small size companies with market capitalizations less than 5,000 crores. These are beyond the top 250 companies in India, and you will never have heard of these companies in life unless you are much into research and analysis of the stock market. Now, this is super volatile, and at the same time, because of the super volatility and risk involved, the returns are also unmatched. This is the category which gives the maximum returns in mutual funds in India. The slightest volatility in the share market will have huge impact in the share prices of these companies, and subsequently your mutual fund value as well, negative or positive. So you have to be careful about the timing and selection of the fund, of the small cap fund that you want to invest in. And if it's done properly, this will give you unimaginable returns, the best in category of mutual funds in India. And as per the latest data, these are the top performing small cap funds. Quant Small Cap Fund gave an amazing return of 50.31% per annum for a 5-year period, and Nippon India Small Cap Fund gave 27.77% per annum for a 10-year period. Now, as you can see, the returns from the top performing funds is in the range of 17 to 50% per annum. Now, where else will you get this kind of returns in India? Nowhere else. So, but still, If you have 100 rupees to invest, you wouldn't deploy the entire 100 rupees into equity mutual funds alone. The proportion of the amount that you decide to invest in equity mutual funds depends on your risk appetite and your goals. So whatever amount you decide to invest into equity mutual funds, how to divide that into these three funds. Should you go with only large cap funds, or only mid cap funds, or a combination of all three? For this, I've devised something called 50-30-20 rule. Now, this is not to be confused with the need, savings, and wants rule developed by Elizabeth Warren. This is something I've devised on my own based on my experience and research. So, what is 50-30-20 rule? This is based on your age category. So, if you belong to the age category of 20 to 30 years, out of the amount you have allocated for equity mutual funds, 50% should go into small cap, 30% to mid cap, and 20% to large cap. If you are in the age group of 30 to 40 years, 50% of your fund should go into mid cap, 30% into small cap, and 20% into large cap. If you're 40 and above, naturally the risk appetite comes down. You need some stability in your life and your returns as well. So 50% should be allocated to large cap, 30% to mid cap, and 20% to small cap. So if this kind of allocation will give you diversified kind of portfolio based on your age category and risk appetite. Now this video is only for educational purposes. I'm not getting paid to promote any of the mutual funds mentioned in the video. So please don't invest into mutual funds based on this video or my recommendations. Hope you enjoyed this video. Hope you got to learn something from this video. Please like, share, and subscribe for more videos like this. I'll see you in the next video. Thank you.